I think we see changes going on in financial services right now, and one of those changes is a merging of types of institutions. Probably more in practice than in form, but I think in the past we've talked about banks and savings and loans, and now I think we've added a new phrase to it called credit unions. Credit unions are financial institutions. Banks and credit unions are different in ownership. Credit unions are typically owned by their deposit holders, or their shareholders as they call them, and meaning deposit account holders. And banks are typically a stock institution owned by shareholders that own the physical common stock. We do see a few mutual banks around and some mutual savings and loans, but the credit union industry is typically one that's involved more with companies and particular types of industries. What we've seen in recent years is that the credit unions have been very interested in acquiring banks and branches and have been very acquisitive, which is a very much of a change in kind of how business is operated. From the banking standpoint, credit unions are now considered in antitrust analyses. In the past, you didn't really consider credit unions because they served a different segment of customer. Nowadays, the Federal Reserve and the Justice Department look at credit unions as competitors, serious competitors, and so they're brought into play when they're looking at anti-competitive. So credit unions have become much more active, and they now can call their customers, and bank, and just as banks do, and so what we find is that credit unions are very competitive. They tend to be very high tech and very attuned to what the public likes with regard to technology, as well as rates that they pay on their deposits and the rates they charge on their loans.